How is quantitative easing connected to public debt? Imagine a central bank stepping into the market with a big shopping cart, buying up a large chunk of government bonds. That's what quantitative easing is all about. It's a tool used by central banks to help the economy grow when things are slow. They do this by purchasing government bonds, which are basically loans the government has taken from investors. When the central bank buys these bonds, it puts money directly into the financial system. This extra cash makes it easier for banks and businesses to lend and invest. Now, here's where public debt comes into play. When a government issues bonds, it is borrowing money from investors. These bonds are part of the country's public debt. When the central bank buys these bonds during quantitative easing, it becomes a major holder of that debt. This means the government is effectively borrowing from the central bank instead of individual investors. The central bank's purchase raises the price of bonds and lowers their yield, which is the interest rate the government pays to borrow money. Lower interest rates mean it costs the government less to borrow money in the future. This connection can help governments manage their debt more easily. When borrowing costs go down, they can fund new projects or cover existing expenses without increasing interest payments too much. It also encourages private investment because low long-term interest rates make borrowing cheaper for businesses and consumers. This can boost economic growth, which in turn increases tax revenues and helps reduce the overall public debt over time. However, some people worry that buying up government bonds might encourage governments to borrow more than they should. Since the central bank is helping to keep borrowing costs low, it might make it easier for governments to take on more debt without facing the usual market pressures. This can lead to larger public debt levels that might be hard to manage in the future. In essence, quantitative easing connects to public debt because it involves the central bank purchasing government bonds. This process lowers borrowing costs for the government and injects liquidity into the economy. While it can support economic growth and make debt easier to handle in the short term, it also raises questions about long-term debt sustainability and market discipline. Balancing these effects is key to making sure the economy stays healthy and stable.